What creates inventory holding costs? The holding costs are the costs you need to pay because you are holding inventory. So what kinds of expenses should you spend to hold inventory? There are many kinds: warehousing costs, state taxes, maintenance costs, obsolescence, opportunity cost. So let's talk about them in more detail. Warehousing costs include labor costs for monitoring inventory at the warehouse. They also include the rent for the warehouse, the amount of money spent for heating, lighting, etc. Next, taxes are holding costs. In many states, your inventory is taxable. If you run a business in Arkansas, Kentucky, Louisiana, and so on, all of your inventories are taxed. Insurances are also holding costs. When your products are highly valuable, you need to purchase an insurance just for the case things get stolen. Obsolescence is another type of holding cost. This is a cost you need to pay because things get obsolete. Let's say you're selling iPhones. You have inventory of iPhone 15. Next month, Apple will launch iPhone 16. When that happens, can you sell your iPhone 15 for the full price? No, your iPhone 15 will become obsolete. So you need to mark them down. So the value of your iPhone 15 goes down. Deterioration. Vegetables deteriorate as time passes. Damage. When time passes, things break down. Theft. Your products can be stolen, and these are the costs of holding inventory. Opportunity cost is also called the capital cost or interest cost. This is one type of holding cost. The capital cost is the cost you need to pay because your capital is tied up in inventory. And it's the amount of money we could have made if we had invested our capital into another investment opportunity. So let's take an example. Suppose you are running a convenience store. You are out of shampoos. You need to buy shampoos from a supplier. So let's say to buy these shampoos, you need $100 and you don't have $100 now. So you borrow $100 from a bank and you use this money to build inventory, to buy shampoos. Now, since you borrowed $100 from a bank, you need to pay interests. So let's suppose the annual interest rate is 3%. How much interest do you have to pay every year? 3% of $100, that's $3 per year. Until when? Until you pay off your debt. So until that happens, you need to keep paying interest, $3 a year. And you can think of these $3 a year as the cost of holding inventory because you need to pay them because you borrowed this money to build inventory. Your money, $100, is tied up in inventory. Let's go to case number 2. We use our own cash. So in this case, we have cash, $100, to build inventory. So you can ask the following question. Since you used your own money to build inventory and you didn't borrow any money, is the opportunity cost 0? The answer is no, because if we invested this $100 into a money market instead of buying inventory, we could have made interest income. If the annual interest rate is 3%, you could have made $3 a year as an interest income. But since you used your money to build inventory, you cannot make this interest income. Not making $3 annually that you could have made is the same as losing $3 annually. So In the second case, when you use your own cash to build inventory, there's still an opportunity cost, and that's $3 a year. So the capital cost focuses on the cost of capital tied up in inventory and the lost opportunity from investing that capital elsewhere. The cost of capital is the largest component of the inventory holding costs. It's expressed as a percentage of the dollar value of the inventory held. Suppose it costs $30 to produce an item. If the annual interest rate is 20%, what's the capital cost for the item per year? So the capital cost per unit per year is the unit cost, which is the amount of money spent to make each unit or buy each unit from a supplier. So in this case, it's $30 times the annual rate for the capital cost. So that was 20%. So 30 times 0.2 equals $6 per unit per year. Remember, the capital cost should be applied to the amount of money the company invested to produce an item. So for example, suppose you invest $12 to produce a pen and sell it to your customers for $20 per pen. The hurdle rate for your business is 26% annually. You want to use this hurdle rate to compute the cost of capital. What's the cost of capital per pen per year? So, how much do you invest to produce your product? That's $12. $12, and the money you could have made by investing this is 26% of this. So that's the capital cost per pen per year. So that's going to be part A. So in summary, when one says that the inventory holding cost is based on an annual interest rate of 30%, for example, it includes all of this: the space, the insurance, capital, the cost of capital, taxes, loss and damage, obsolescence.